To talk about activity accounts, so you may want to have page 35 out because these are the accounts we're talking about now: your revenues, your expenditures. And so activity accounts, so they do get closed, right? They're going to get closed out to the fund balance at the end of the fiscal year, and we start over. Somewhat akin to the income statement accounts, revenues and expenses, but we call them expenditures. All right, so the government has sort of like its own sources of finances, which we call revenues. So when they declare taxes, income tax, sales tax, property tax, any kind of tax, or fees that they charge, right? So if you go down to the county courthouse, county revenues are things like, license fees and taxes for license plates and things like that. Getting married, pay that. So any little fees that they charge, they get to keep that as revenues. And remember, we're talking governmental, right? So kind of put out of your mind for right now, right, that yes, of course the water department charges a fee for services, right? Of course, and it's actually tied to a service. We provide these many gallons of water, we charge this much per gallon, and that's certainly revenue. But keep in mind that this is the general, this is the governmental funds, and we're using modified accruals. So it's not this one-for-one provide a service. And this sometimes, yeah, fee. Obviously, you went down to the courthouse, you renewed your license plates. There was a fee for that. But for the most part, we're talking taxes. There is some other financing sources. That is when the fund transfers in money from borrowing. This word expenditures, that's when a liability occurs that will be settled with current financial resources. So expenditures may be for salary, capital equipment or something like that, paying interest. An expenditure means you're paying for something. You've incurred this liability that you're going to pay for. And transfers out go to other funds. Right? So remember how we said that when we keep these funds, right, they don't, there's not debits and credits across them. In other words, you would never have a revenue come into special revenues and then, out of special revenues, you would make an expenditure, right? They get theirs. But once in a while, general might transfer some money over to one of the other funds. So they have their funds, right? So that's a other financing use. So if you look at page 35, you'll see that expenditures are getting classified by the revenues are by the source, and expenditures are by the function, however it's being used, the character. All right. So under revenues, you're going to have things like taxes, fees, charges for this, charges for that, miscellaneous. In this case, we have taxes, charges, intergovernmental, and miscellaneous. Expenditures, are going to be for what you use. They'll be classified as current capital outlay and debt service. They'll have some main categories, and then whatever you want to call them. Just depends on what the organization is. They'll have different programs, different departments. All right. Now, under expenditures, you'll have these groupings of current capital outlay and debt service. And current are then subcategorized by function. So however many accounts you want to have, you will have general government, public safety, streets and highways, whatever. Here at the university, I'm sure we have things like College of Business, College of Engineering, right? Things like that. But so their function. And then you can have sub accounts, right? Police, Public safety could be subdivided to police and fire, police further subdivided by traffic and drug enforcement, and so on and so on. So you're going to have different accounts as you go. Now, what's interesting, you may have noticed back when we were talking about activity accounts, we showed budget accounts, which is kind of interesting. So the governmental accounting standards say you have to present your budget and your results. So here's your results, right? And you have to present your budget. So that means you're having to keep track of the budget, all right? And of course you want to keep track of the budget anyway. But what happens for governmental entities is somebody approves and gives you a budget. They say, this is how much you can spend on this. So at the state level, the state legislature votes on the budget every 2 years. And everybody goes to Austin and asks for their money, like the president of the university will go up to Austin and say, we need this much money, and they vote on it. So, although there's not a specified practice under the accounting standards for doing these budgeting accounts, you have to still do them because you have to present your budget, how it came out. So you have to have some way of doing it, I guess. You have to figure out some way. So they're not financial statement accounts, right? This is our budget. This is what it's a plan, right? So your budget accounts are how you plan, what you plan to do with the money, how much you plan to get in, and how you plan to expend it. All right. However, government systems have to be able to show they were responsible with the people's tax money, and so we actually post transactions to budget accounts. All right. So the budgetary accounts include estimated revenues, right? So we say, okay, well, we believe, like you can see, like Clayburgh County is going to say, okay, for the year 2019, they're probably thinking about this already. The year 2019, we have this much property value in our county, and this is our tax rate, so we anticipate collecting this much in property taxes. We think these many people will get license plates, so here's that tax. We think the sales tax, these many millions will get spent, so we think we'll have this much in sales tax, all the fees, things like that. So they estimate their revenues, and we actually do a transaction and we post to the budget accounts our estimated revenues. Same thing with appropriations. An appropriation is the legal authorization for spending. So you'll hear this term, the appropriations bill at the legislature, right? So in the state of Texas, all the universities and Department of Family and Children's Services and the Department of Public Safety and the Highway Department and everybody who gets money from the state of Texas submits their budget. The legislature considers it and they figure out, okay, they put it on a bill and they pass the bill and the governor signs it, and that's the appropriations, right? And so once the funds have been appropriated by the legislature, now we can put those on the books in our budget, right? Until Texas A&M Kingsville doesn't know how much money they'll have to spend from the state until it's actually appropriated and signed by the governor. So once it's signed by the governor, then we know, and we can put that on our books. Now, I already kind of explained this idea of an encumbrance. When a governmental entity contracts or something, they want to make sure they're not overspending. They want to make sure they're keeping up with the money. They're using it for the right purposes. So when the government commits to spending some money, so when A&M Kingsville commits to giving me $1,500 to go to a conference, I haven't gone, So it's not a actual liability. They don't really owe me the money, but they want to set it aside and save it. They call that an encumbrance. So there's transactions associated with encumbrances. So what happens is, as we put this money on the books in the budget accounts, right, which is not really a transaction when you think about it. I mean, that's a modified accrual basis. The legislature appropriated, I don't know, let's say they appropriated $100,000 for professors at Texas A&M Kingsville to travel to conferences. So there's $100,000 in the budget. I went and asked for $1,500 of it and got it encumbered, right? So they do an accounting transaction. They say, okay, when it was appropriated, they put $100,000 in the professor travel budget account. Now I've asked for some of it, so they moved $1,500 out of the budget account and into the travel encumbrances, something like, I don't know what the name of it is, but it's probably something like travel encumbrances. So now there's $1,500 sitting there for me. After I take my trip and submit my receipts, then that will move from travel encumbrances, that $1,500, from travel encumbrances to travel expenditure, because it really happened. So, in actual accrual-based accounting, that expense wouldn't get recognized until we use the asset up. But it got recognized in the budget, got recognized as an encumbrance, and eventually it will become an expenditure. Right? So, this is what the expenditure cycle looks like, if you think about it. So, this is an example of a city. City council approves the budget. Great. That goes on. Now it's going to look, and the budget includes the revenue. So we're estimating our taxes, we're estimating our expenditures. And if you look at this, it looks kind of weird, right? Here's these revenues are going down as a debit, right? But eventually, right? So in the appropriations are going as credit. So in other words, what's going to eventually become expenditures are going down as credits. Well, that's because as we move them through the different accounts, they will eventually end up as the tax comes in and it will become a revenue credit, and when the encumbrance gets used, it will become a debit, but not until they get used. So that's kind of how that works, right? We keep moving it from account to account. So once goods and services are received, then they have a liability, right? So when I come back from my travel, now they owe me, right? I've put in these receipts. So it moves from budget to encumbrance, from encumbrance to liability, then it will move from liability to expenditure. Well, why go to all that? That's a lot of recording. Well, really it prevents overspending. It makes sure that the funds are getting used for what they're supposed to be used for. It's a form of internal control. That really is all it is. So that it makes sense for governments, and because you got so many people with to answer to, and you want to make sure that it's getting spent the way it's supposed to be spent, you record those encumbrances. All right, so here's an example. So now remember, before this encumbrance occurred, right? There was a budget, right? So somewhere back in, so we were buying 3 minibuses. Okay, so somewhere back when the city council was approving this year's budget, they approved, who knows, 10 minibuses. I don't know. Maybe they improved a bunch of maybe they just improved transportation budget purchases. some amount. And so then somebody decided to buy 3 mini buses. Well, it takes a while to, buy a vehicle and get it delivered, but they wanted to make sure nobody else spent that money on something else, so they encumbered it. I said, we are buying 3 mini buses. We're going to spend $150,000. Right? And we put that on encumbrance. Right? So remember when we first put the budget on, if you go back up here, I think didn't we do that? No, we didn't. Okay. It didn't really show. Well, here's the budget, right? So here's the budget. When we budgeted it as a credit. Right? Alright. Alright, where is that? Alright. So we put it on as an encumbrance. So we debit that and credit the budgetary reserve. And here's an example where they arrive, but they cost 102 instead of 100. So we reverse the first part and change it and put back the actual expenditure. So that's just an example. I mean, it works out all good in the end. Accounting for revenues. So here's the issue with modified accruals for accounting for revenues. There's not an exchange transaction. The government just says, pay us this tax, right? So you don't really know when they're actually earned. So of course we put them down in the budget, right? We've already established that we do these budgetary transactions. But when do we actually recognize them and take them out of the budget and put it into realized? Well, we realize the revenue when it's measurable and available to finance expenditures. That's the rule. Measurable and available. So for a non-exchange transaction, the government receives resources without actually giving equal value. So the most common thing are taxes and grants, right? So we're going to get this money. We don't know exactly 100% for sure how much sometimes, especially with taxes, because not everybody pays it. But we know we're going to get some. And so we must meet the eligibility requirements to recognize the revenue. And so in order to have non-exchange revenues, which means put something down as revenue when there's not, we sold you a service, we sold you a product, the recipient has to have the characteristics specified by the provider. So it's got to be a government, it's got to be a school district, something like that. It's got to be, time requirements have to be met. In other words, you have to pay us this tax within a certain time. For grants and gifts that are payable, revenues are recognized when expenditures occurred. So here's a grant for providing school lunches, but you have to provide the school lunches and then you get reimbursed. Or contingencies. Some resources have a contingency and are not recognized as revenues. Like a matching grant. Like City of Kingsville, you want to buy a new fire truck. You know what? We're a organization that helps people finance fire trucks. And if you raise half, we'll give you the other half. That's a contingency. So, types of non-exchange transactions. So, they're typically, just like you would think for government, taxes, right? Property tax, special assessments, fines, forfeits, derived tax revenue. So the difference between imposed is they just say, you own this property, you have to pay us this much tax, period. That's it. We're going to put sewer out to your property. We're going to assess you $10,000. You have to pay us, right? That's a property tax special assessment. It's imposed. So derived, like the word derive sounds, it's based on something else. It's derived from a sale. It's derived from an income. So sales tax, income tax, gasoline tax, right? Those are derived from something else. However much is sold, the city gets a certain part of that in tax, right? Government mandated transactions. The government requires certain expenditures, so the government says you have to pay the state of Texas, you have to pay Medicaid, we'll give you some reimbursement back. And voluntary grants and donations. So an organization says, hey, Texas A&M Kingsville, we're gonna just give you a grant to do some kind of research. All right, so that's voluntary. All right, so we're going to stop right there, and then we'll finish up the chapter.